Okay, hello everyone, and welcome to our training session for today. Today, we're going to be discussing the SMC concept order block, right? So what is an order block? Why should you want to pay attention to, or at least understand the concept of order block if you want to use that as part of your trading tool? So how does it work? How are order blocks formed? And then why do we expect price to act in certain ways around when order blocks occur? Okay, so first of all, we're going to begin by what exactly is an order block. Now, don't let the name confuse you. An order block is just basically what it shows you information as to what's actually going on in the market. It's a market behavior that reveals where a pile of orders by large entities have been placed. I remember when we were looking at Wyckoff, I usually, I call we call the main movers in the market the composite man, right? So let's use our example of Wyckoff, right? We say that if the market is accumulating, it does so in stages. Like you see, the market probably make a PS as a primary supply support, a selling climax, make an automatic rally, so you see the market do something like this, make a spring, and then eventually begin to break, right? So we came to the conclusion that before the market reverses or change trends, there is some sort of accumulation or distribution in price. And within this accumulation or distribution phase here, what happened is that the smart money, right, or the composite man is accumulating orders in order to push price up, or distributing orders in order to push price down. So let's say this is an accumulation in the sense where smart money or the composite man is accumulating these orders in order to push price up. Here's what you want to think of. Here's how you want to think about price. It's unlikely that your money and my money can even move price one tick, right? So when you see a candle make be a bullish, let's say the market forms let's say this is a 1 hour chart, right? And the market is making a bearish candle, right? Now, for example, how is a bearish pin bar formed or a bullish pin bar formed? Well, at some point, that bullish pin bar was a very big bearish candle, right? Now, remember that the composite man is the man that controls the market, basically, not necessarily controls. Now, when I say composite man, it's not one entity, it's just where the money is flowing. So what happens is, in order for this candle to go down, right, it means that the composite man, now I'm going to use the term composite man as though it's one person, but like I mentioned, it's not just one individual. It's in order for price to go down, remember, before this candle becomes a bullish pin bar, it was once very bearish, right? So this candle here is what eventually turns out to become this one, right? So what happens is, that means at some point during the lifetime of this candle, this is actually what was happening, this bearish candle here, and then eventually this push up. Now, who do you think pushed price down? Whose order do you think makes price to fall? Is it your money and mine? Well, no. The composite man induces sellers by actually causing this candle to be very bearish. Now, retail traders like you and me who get excited because of price is breaking below, or price has broken below, or something of the nature, get involved in this only for the composite man to then push price back up, right? So essentially, what we are saying is, in this area, for example, in this area of accumulation here, the composite man is not only accumulating orders, not only buying. He is, so let's say here will be buy, there'll be a buy. They'll place, let me tell it in terms of lots, right? So they might place 100,000 lots of buys, and then eventually place 80,000 lots of sells, right? So they'll be placing buy, sells within this region. Do you understand? So they might place 100,000 lots of buys, place 70,000 lots of sell, place another 80,000 lot of buy, place 40,000 lots of sell. So they are doing a lot of buying and selling and buying and selling and buying just to confuse price and just to make price react in a certain way, just to accumulate the orders. Remember, the reason they are doing this is to get other people involved to take the opposite side of the trade, right? So let's say they are accumulating, they want to take price up. What they are trying to do is get more people involved in selling so that they can take their losses or their stop loss or their buy stops or their sell stops as liquidity to make price go, to run price to the direction they want to take it to, right? So what's happening here is there's a lot of buying and then there's a lot of selling, and a lot of buying and selling by the same hands. Now, here's the way it works. They don't place these buys and sell with stop loss or any of those things because they have trillions or billions of dollars in that market. So they can afford to have some open positions running, right? Now, so we have lots of orders left in the market within this accumulation phase. For instance, it could be a distribution, but we're using accumulation as an example, right? Now, what happens is, by the time they've accumulated enough orders, right? Let's say the smart money or the composite man wants to buy 1 million units, right? Wants to buy 1 million lots. Yes, price has gotten to the level and they're not interested in selling it. They cannot just inject 1 million lots into this market. Why? Because there's not enough volume in the market to accumulate all the orders. Because remember, if you're buying, it means somebody has to be selling. So what they will do is they will inject this 1 million lots in blocks of orders, right? So they will buy, they will sell, they will buy, and they will sell. So it's a lot of buying and selling and buying and selling that is going on here. And by the time they've accumulated enough orders, then they would now release their buys, and then you will see price go the actual direction that the price actually intended to go in the first place, right? Now, in doing so, they leave back some. In doing so, most of the time, there are many leftover orders, right? There are many leftover orders in the market. Basically, now let me go back to the same example here. Basically, remember they were buying and then selling some, and then buying and selling and buying and selling. Now, let's say they buy all this. Remember, where they really want to take price is upwards, right? So they buy and then sell. So they might buy 100,000 lots, for instance, and then sell 40,000 lots. And then accumulate another 150,000 lots buy, and then sell another 80,000 lots. So they keep on with the buy and sell into the market. Why? Because they are inducing traders to, when they start doing this, people start looking at these areas as, oh, this is resistance. Oh, down here, this is support. If I buy, I'll place my stop loss here and that, and all of those. And it's actually why you have those springs in the markets, because, the market wants to go up, you start buying, the market comes down, flush you out, and then begins to go up. The market just came down to grab all the orders that were down below here, right? Now, once enough orders have been accumulated in the markets, what you see is that price begins to move in the actual intended direction, right? Now, but when they do that, because as price is coming down, so as they are buying and selling, they are closing some of their sales because it's still within this area, right? So they buy 100,000, they sell, then they buy and they sell. So within this area, they are sitting on a ton of losses, right? They're sitting on tons of losses, but then the price usually comes back and they will close back those losses at break even, right? Or at least close to break even, for them to now eventually push price up. But in many cases, when price eventually shows its hand in Wyckoff terms, we call it the SOS, which is sign of strength, they would have left a lot of sell orders. And as price is moving up, well, what do you think is happening? These sales, the losses are getting bigger and bigger. So Orderblocks concept is based on the fact that usually at some point, the market will come back down so that they can close their previous sell trades, right? They can close their previous sell trades before price then eventually goes back up, okay? Now, what we just discussed now seems like a handful. But hopefully you grab the concept. Now we'll go and look. We'll go and look at the chart and see if we can find examples to explain the concepts. Okay. So let me share my screen again. Okay. Now you can find this concept, or you can find the application of this concept on any single instrument, every single time frame. You would see price move, because remember, the composite man is not operating candlesticks like you and me. They are usually operating order flow, order books, right? So they are looking at order flow in the market, not necessarily candlestick. But if you understand how price move, you can see the order flow by looking at the candlesticks. Some people might use volume and all of those things. I don't necessarily use that, but you can see price movements in the markets by looking at the order flow, right? So now let's take, for example, now let me see. I'm going to find a clear example, but I know I can pick any particular setup and I'll show you a good example of that, right? Now let's take, for example, okay, let me go down to the 4-hour time frame here. Right? And let me look for the end of a trend. Now look at this, for instance. Look at this down here, right? Now look at that area down there, for instance, right? Remember our understanding of Wyckoff. Now this is not the clearest of Wyckoff, but you get the idea. Before, the trend has been bearish, and then all of a sudden the market stalled for a little bit and then broke, started going bullish, right? Now, at some point, this could have been it. This, you can even tag this its own Y curve, where price accumulated and broke down. Probably the reason it breaks down is because there's still orders left. There's still lots of liquidity to the downside, and the market came down and cleared it. Now, here's the point, right? Notice what went on within this region. Price began to range. So in this case, we could call this our preliminary supply, our selling climax, our automatic rally. We have our secondary tests. We have, a spring, basically, price push up. So you can see how price ranged a lot, within this area before eventually breaking up. The price broke up, and then what happened? Price came down and then decided to move, right? Now, what do you think happened here? Using our example, right? Using our example of our detailed example of how the composite man pushes price. Well, within this region, they already want to move price. They already know the direction they want to take price. And remember, your job and my job is not to guess the direction. It's to wait for them to show us their hand, then follow the basically follow who know road, right? It's for us to wait. It's for us to wait for them to show us their hand and then follow them in terms of where they've decided on where price should move. Now, in order for price to go up, there are a lot of buy and sell and buy and sells and buys and sells within here, right? For price to then push up. Now, when price actually shows its sign, show its hand, you'll see that here. This will be what we'll call our sign of strength. Remember when I taught you Wyckoff here, where they actually broke out of the range after springing lower. We had the break out of this entire structure here, showing the sign of strength. What did price do? Well, it came back and we tested, came back down. And then, what do you call it again? Push away from there. Now, another block would look like this. What you want to, usually another block is followed by an imbalance. Now, I think I've had a training on imbalance before. Candles like this. So you can see this red candle, and then you see this big green candle. There's an imbalance here. Notice that all the previous candles, their low to highs are connected. Basically, the close of this candle is connected to the open of the other candle, right? But look at this candle. The close of this candle is here. Let me draw that out here, like so. And then you can see that it did not connect to this other candle. So most of what happened here is there's an imbalance here, And most likely, if the composite man has not, in many cases, if they've accumulated if they just finished accumulating, most times you would see price come back and clear out this liquidity, because what happened here is they left a lot of sell orders open here and price began to push upwards, right? So many times they will come back and close, so price will come back down to what this imbalance here, close that block. At least they will close their open sell position so that they can close them for at least a minimum loss before moving price up. So look at that here. Look at this here. Let me highlight that with a rectangle. Look at this area here. We had this aggressive push up, right? And then what was left behind? You can see this candle here, right? So you can see that area there. An order block was left because there's an imbalance here. The market came back, filled it partially, and then we had this breakout of here. Now, what happened after that is this. You can see that price came back. Now, it's not going to be an exact 100% science all the time. Sometimes the market will come down weak below it and then break back above. But the idea of order block is that once the composite man has made a decision as to whether they want to push price up or down, most times, at least on a smaller time frame, you would see leftover order blocks that they would usually come back and close, right? It's called mitigation, right? Usually, you don't see candles like this. You can see all of these candles, they are connected, right? Even this big two, this red and green, they are connected. You can see the close of the low of the candle is connected with the open of the next one, either the low or the high, depending. For candles like this, you can see the market just broke, moved away, and did not come back to fill. So there's an imbalance there. And when you find imbalance with leftover order blocks, so in a nutshell, I think when you see, let me see if I can quickly. So let me draw with my candle. So let's say we have a candle like this that is bullish, right? And then let's say it closes there. Oh, what am I doing? What's the best way to explain this? Why does everything keep? Let me take this away. Okay, so you know what? Let me use the candles itself, right? So for instance, you can see that each of these candles, like look at all the candles, most of the time they are connected, right? The candle to the left is connected to the candles to the right. The current candle is connected to the candles to the left, right? So for instance, you can see that, say this candle, for instance, look at where it closed. The opening of the next candle should be connected to the close of the other candle. Now, the whole idea is that at least the high or the low of the next candle, of the current candle, should connect to the high or the low of the previous two candles. So if you take any candle, for instance, let me go to the most recent candle, right? If you take this candle now, the high or the low should be connected to the high or the low of the next two candles. So this candle here should be connected to this candle here. Right, let me zoom in a little bit. And basically that's the idea. But look at this candle. Look at this candle and look at this candle, right? There's nothing connecting these two candles, right? Because as you can see, the low of this candle is here, right? And the next candle is here, something like this. Basically, there's no connection, there's a gap, there's an imbalance here, right? So usually the market likes to feel this type of, it likes to feel the imbalance. So you find that price would find its way back within this imbalance, right? Find its way back to fill this imbalance. And then if there's a leftover order block, that area could serve as a potential area to sell from. That's the whole idea of order blocks. Now, that is the most general definition or most general explanation for order blocks. But in terms of not every order block is the same, not every other block is tradable, right? Or you shouldn't be trying to trade every single order block just because then there's an imbalance. there are certain strategies that are dependent on imbalance, right? So for example, I used to have a, there used to be a system. So for example, if I see something like this in the past, I start watching for this area here for price to come back to it. This is an order block here, right? That's another block. And immediately price gaps down like this and leave gaps. I'll start looking to trade my way back up here because there's an expectation that price will most likely want to come back up here to fill this imbalance here before maybe moving down or moving up, right? Now, that's the way I used to trade it in the past. But right now, I don't try to trade counter the move. I trade in the direction of the trend. But what I tend to do now is use the order blocks as areas to continue in the direction of the movement, especially after an accumulation or a distribution. So for example, in this case here, as you can see, we had the accumulation, price showed the sign of its hand, right? And then pulled back into the region. So as far as it's pulling back into leftover order blocks, I start watching for confirmation to buy, right? I start looking for confirmation to buy within this region. Again, you can see price pull off again. I ask myself, where is the order block that it left over, right? Where is the imbalance that price has left that needs to be filled? At least in the direction of this trend, and then I identify it, right? Remember, we're just identifying potential areas to buy or sell from. So for example, this would be the imbalance that I'll be looking for. You can see why it's an imbalance. You can see there's an imbalance here, there's an imbalance here. There is a leftover candle here. So what it means basically, right? What it means is, where is my brush? What it means is the composite man took a lot of sells, right? They placed a lot of sell into the markets and then aggressively placed a buy. That means, yes, while their buy is making profits, right? The sell, as the price is moving up, the sells are, getting bigger and bigger. So most of the times they'll come back, at least partway, close their sales before eventually taking price up. That's the whole idea of order blocks and why it works. Now, let me see. I think there's a good example of this on Euro USD that we can highlight. So let me see. So for example, look at this chart here. Now, even this area here is actually an accumulation, right? At least in hindsight. You could see how price has been bearish, right? So price has been bearish, bearish, bearish up until this point. And what did we see next? Let's give ourselves room. Right, so price has been bearish down into this region. And then what did price begin to do? Well, price made, this will be what you call preliminary supply. We had we had a low, broke down again, probably another preliminary supply. And then price began to stay within a range, accumulating, this is where they're accumulating orders, buy orders to eventually take price up. Now, after accumulating enough orders, they push price up. Some of you who know me, who know when we're doing this analysis, we were looking for price to come back down here or potentially down here before we take price up. Now, this is also another thing you need to note about prices, about the composite man is they would not, price would not always act the same way, at least not on every time frame. You might be looking at this on the daily chart and, expecting price to drop back down here. And price just keeps going up like this. The mistake people do is, well, they still keep expecting price to come back down here instead of looking at the fact that price is making new structures and creating new liquidities, right? And obviously, this order blocks, remember, everything I teach you, everything I tend to talk to you about is always in relationship to market structure. So basically, the idea is if price, maybe after accumulating, breaks up like so, and leaves an order block like this, what we are doing is we are anticipating for price to come back down here. Now, if price gets there, what are we looking for? We're looking for buys to take price in the upwards based on the idea that price has broken structure and is interested in going up, right? Now, the problem is, or the mistake most people make is, so let me push this down. So let me push this down like this. And let's delete this for now. Okay, so let me draw that again. So let's see, we have price doing something like this. So accumulating, well, and then eventually we see the sign, price breaks high, leaves an order block, right? So there's an imbalance candle. Sometimes it's called fuck you candle, right? You know how you do the middle finger candle, where the middle finger is just what you call it, is just higher than the other candle. So if you do the middle finger and show it to yourself, you see that your middle finger is just higher than the candle to your left, higher than the candle, it just leaves gaps, right? So what that means, what's the idea is that price usually might, in most cases, will come back down to close that gap before eventually going up. So what we're looking for is for price to come back down here. We're using the order block as an area to watch for confirmation to buy. What you don't want to do is, what most people do is, let's say they see this and then there's an order block. It varies, oh, this is a nice order block. They start trying to force sales into here. The price must come down here. It's not guaranteed. It doesn't always do that, right? What you want to understand is the path of least resistance, the path of high probability is that price is most likely going to come back up here. This is, where our target should be. Sometimes it might come back down here before going up. Other times it might just make shallow retracements before going up. Now, if this happens, this order block here is no longer valid, at least in the context of this market. You start looking to see if there's an order block you can find here, and maybe price comes back down here, and then you try and trade that. The problem is that people look at order blocks in the sense that, oh, this order blocks is missed. They start waiting for price to come back down here. And at the time price begins to come back down there, right? So the price do something like this and go up. They are still waiting for this particular order block. And then by the time price begins to come back down there, he's no longer interested in respecting that. It will run it and keep going. And they're wondering, this thing doesn't work. It's just jargons. It's just bullshit. It doesn't work, right? So the whole idea about order block is understanding what went on within the market, and what the composite man is actually doing and how you can take advantage of it. Now let's look at the example within this trending structure here, right? So you can see here price is bearish, right? Now each time price makes a move, now let me take this area here. The price makes a move from here down to here, like so, right? Now, where is the order block? Where can you find order blocks? Now, what does order block, what will it look like? In most cases, it's a candle that is imbalanced with leftover price. And that means in a bearish market, it will be a bullish candle, a very big bullish candle that is then preceded by a bearish candle, and then price falls off, leaving imbalance, right? So that imbalance there, although my drawing will look very sketchy, that imbalance there okay, so the idea of that imbalance there now serve as a target region where price could potentially go back up to before pulling back down, right? Now if you I want to use an example of something of another block that is very visible, so you get the idea. Once you get the idea, XAU-USD. Okay. Okay. Now let's look at this, for instance, right? Bearish markets, this is high, this is low, right? Now, what do we see here, for instance? Look at this imbalance. Can you see that imbalance there? There's an imbalance in that candle where, let me zoom in a little bit. There's an imbalance there where you can see that this candle is just ridiculously just left the other one here. This next candle is not connected to that one. It left an order block there, and price continued to fall and fall and fall. And this is also another reason why you don't try to, immediately you see an imbalance, you start trading towards it. Imagine if you saw this imbalance and after this candle, you start trying to buy to this point. Markets will just keep going down and going down. Eventually it came back up, but you might have lost your account or taken a huge loss, right? Now, look at this. Let me delete some of this. right? So let's identify that block. Here, what happens is, here, right now, it means that the composite man left a lot of buy orders open within these areas because the market fell off, right? And remember, even within these areas, composite man is still buying, even though they are selling more. So they are buying, but they are selling more than they are buying. It's as if you're buying 1,000 lots, selling 20,000 lots. Resultantly, the price will be going down. But your 1,000 lots would still be open, and it will still be, the losses will be getting bigger and bigger, even though your profit is getting bigger and bigger as well, right? So in many cases, price goes back to previous order blocks and then continue in the overall direction. This form a basis for an area of interest or zone of interest for us to start looking for potential continuation of the trend, right? So you can see that here, price fell off, right? The market fell off the cliff. And then after a long time, this took several weeks, what happened? Price came back up to that order block and did what? Accumulated again or redistributed there. Now, if you go down on the smaller time frame, let's say the 1 hour chart, maybe even the 4 hour chart, this region here would have its own Y-curve distribution schematics, right? There would be the SS, the preliminary supply, this buying climax, the UTAD, the secondary test, all of those things would be within this region where you find enough, you find smart money redistribute price again to then take it down, right? But identifying that area is one key thing. Now, last week or this week, we were looking at gold and we said, let me go back to our recent charts. Those of you who remember, it was on the 4 hour charts, right? It was on the 4 hour time frame here. And I made mention of the fact that, price broke down from here. So we had this breakdown here, which is our break of structure. And we're saying, okay, price is most likely intended in going up, right? In going down, sorry. However, I'll be interested in looking for sell opportunity if price come down here, or sorry, go back up here or go back up here. I'm sure now you should begin to understand the reason why we're looking at those areas, right? You can see we had leftover order blocks. You can see there's this imbalance with the leftover order block, another imbalance with the leftover order block. So that area is interesting. At least it means that the composite man left a lot of sells, a lot of buys there to push price down, and those buys are sitting in losses, right? Now they are obviously making money, but in many cases they go back to mitigate some of the buys before going back down. Now, it's not going to be all the case, because if it happens all the time the same way, everybody will take advantage of it and they will not be able to make money. So sometimes they go back and mitigate price fully. Other times they don't go back and mitigate price fully. But the challenge is that most people will try to, will be looking at these blocks forever. And I made mention of this, that if price comes back down and takes away this area here, that I'm no longer interested in looking for price to go back up. I don't know if I'm sure some of you should remember. I said if price breaks down below here, right, then I'm not interested in looking at those two other blocks anymore, because, well, they are not interested. They're no longer valid, basically, in my opinion. It doesn't mean that if price comes back up there, it won't react. It most likely, if price comes back up here, we could see a small reaction and then maybe a continuation or something like that. You can trade that, but that's not the way I trade. I look at everything with structure as the main priority, right? So I'm asking myself, what is structure saying? What is the recent order blocks? Now, so in this most recent area here, I'm looking at this as a breakdown. There's also, you can say there's also another breakdown here, like so. And this is the most recent break I'm looking at. Therefore, the most recent order block I'm interested in is this one. You can see it here, right? You can see it here. There's an imbalance, leftover buys. You can see it's like a middle finger candle, basically. Price went up, aggressively going up. Who do you think make price go make this bullish candle for 4 hours? It's not retail traders, it's the composite man. And then eventually price dropped down in the direction of the overall structure, right? Now it means the leftover buys here, which they might come back and mitigate those buys before going down. So if price comes back up here, what would I be looking for? I'll be looking for sell opportunity. Where will I be targeting? I'll be targeting the most recent low. Why? Well, because the structure of the market is bearish, and that is the most likely direction for price. Now, if price breaks this one and begins to go up, I'll ask myself, has the structure changed on this time frame and on the higher time frame, right? So remember, the higher time frame takes more precedence, has more precedence than the lower time frame. But basically, I look to get involved on the lower time frame. Like, you can apply the concept of order blocks on even the 1 minute, structure, right? 1 minute time frame. Now, this is going to be a lot more trading, basically, and a lot more concept. Now, look at this. Let me see. Look at this range, for instance. So let me highlight this. This is going to be the high, and down here is the low, right? So price dropped like this, right? What did it do? Well, price left another block, like so. Right? Now I can keep extending this to the right. Now remember that all of this action here, as long as price does not go down below this low, it's just noise, right? Now, in this case, the price is not really come back up to retest it. It just, this is not a good example because price did not really go back up to retest it. Oh, it actually did. It actually did. Trading the 1 minute time frame is much more complicated than trading the daily time frame anyway. But those are the time frames I tend to look at when I'm looking to get involved in my entry. Now you can see that now you can argue that price broke below down here and all. This is what I'll call as absorption, right? Absorption. It's not a clear break. And then you see price came back after lots of candles, after lots of 1 hour candles, eventually came back up to this area. And what did it do? You can see it's also distributed. So weak to strong hand transfer. What do I mean by weak to, when I was teaching Y curve, I thought it weak to strong hand transfer, where we have this movement where price is going up, all of a sudden price breaks down, and then we see this movement. So this is weak to strong hand. That means the buys were taken away from people who were buying, and then we have the break of structure lower and then the continuation lower, right? And that's what happened here. So this is, basically the order block would have served as an area to watch for sell opportunity. Why? Because the structure of the market is bearish. There's a leftover order block here that price might want to come and mitigate. And then eventually what did price do? Price came back up here, mitigated that. Now, we're not just going to place a pending sell or anything. We want to see confirmation here to sell. And you can see we got that confirmation here. We had the break of structure. Price came back. We tested that area again. And then that would have been an area to get involved in a sell, maybe stop loss above here and target back down the lows, this overall low here, at least on this 1 minute time frame. You could even use the higher time frame low as a reason to even get involved in that trade, right? So the concept of is actually a little bit confusing, especially if you're just getting it for the first time. But once you begin to look at the market in the form of, okay, the market leaves leftover order block, how does price react when it gets back toward those areas? What is the structure of the market before the order block was left? Because the market will leave order blocks in both areas, right? So even a market that is bearish and wants to continue bearish will leave bullish order blocks. Doesn't mean that price has changed. The structure of the market is very important before anything else in the price. Now, we've discussed a handful. Remember, you can always rewatch until you maybe grasp the idea, and then the recording will be made available to you. But now I'm sure you have lots of questions, or some people have questions. I'll take your questions. If you're watching this from the Courseware or maybe the YouTube, drop in your questions or leave likes, and I'll definitely try and do my best to attend to them. But for now, that's the whole idea about order blocks. Leftover candles with imbalances. Those are interesting areas to watch for. And then when price gets there, we'll look for continuation in the overall direction. So, basically in this particular 1 minute time frame here, there's another block here. You can see it, right? There's an imbalance. If price were to come back up here, there is a good chance price will continue going down. Now, it doesn't mean you want to now start trading every single thing on a 1 minute time frame. You'll probably make a lot of losses. You want to have a higher time frame perspective, and then you might now go down to look for. And you want to not just have a higher time frame perspective. Higher time frame order blocks are more, when price gets to them, they're more concrete than lower time frame order blocks. Now, price might not always get, so you might be looking at the higher time frame on the daily chart, and that might not be respected. The market might be looking at the 4-hour or the 1-hour order blocks or the 8-hour order blocks. So it's understanding the actual regions of the actual zones of interest, and then watching for confirmation within those regions. But the whole idea is when the smart money or the composite man leaves leftover orders, they tend to usually go back to close those orders before continuing in the overall direction. So when they are now moving price to close those orders, you want to identify those areas where they are closing the orders, because what happens is when price gets there and they close their orders, well, price moves aggressively in the direction they actually intend it to go. Okay. Yeah, so that's our discussion for today. I hope you're able to pick up a thing or two. And I hope you enjoyed the training. Okay, so I'll see you in the next one.